Thank you for your interest in watching this video. Each of the practice questions you see adheres to the examination format and difficulties. Please note that the questions will not appear 100% the same in the real exam, as we need to respect their copyright. However, the carefully crafted practice questions and the detailed explanations right after each of the questions will help you prepare for the exam effectively. Please note that we spend thousands of dollars to create videos like this, hiring professionals in specific areas, and filtering useful practice questions that are relevant to the exam, all completely free for you. Why? Because we understand that it's difficult enough to prepare for an exam and to pay for the examination fee. All we ask for is 2 seconds of your time to subscribe to this video, click the like button, and let us know if the video is useful to you by commenting down below. It means the world to us. Many thanks and wish you success in your exam. Leave a comment below if you want any specific exams covered. Question 1. Mr. Anderson, a resident of Kansas, is considering purchasing a life insurance policy to provide financial security for his family in the event of his untimely death. He wants a policy that offers both a death benefit and a savings component. Which type of life insurance policy would best suit Mr. Anderson's needs? A. Term life insurance. B. Whole life insurance. C. Variable life insurance. D. Universal life insurance. The correct answer, B. Whole life insurance. Explanation. Whole life insurance provides coverage for the insured's entire life, as long as premiums are paid. It offers both a death benefit and a cash value accumulation component. The cash value grows over time on a tax-deferred basis and can be accessed by the policyholder through loans or withdrawals. This type of policy offers stability and guarantees, making it suitable for individuals like Mr. Anderson who seek long-term protection and cash value accumulation. In Kansas, regulations governing life insurance policies, including whole life insurance, are overseen by the Kansas Insurance Department, ensuring that policies adhere to state laws regarding consumer protection and insurance solvency. Question 2. Ms. Parker is comparing different types of life insurance policies available in Kansas. She wants a policy that offers flexible premium payments and the potential for higher cash value accumulation based on the performance of underlying investment options. Which type of policy should Ms. Parker consider? A. Term life insurance. B. Whole life insurance. C. Variable life insurance. D. Universal life insurance. The correct answer, C. Variable life insurance. Explanation. Variable life insurance allows policyholders to allocate their premiums among various investment options, such as stocks, bonds, and mutual funds. The cash value of the policy fluctuates based on the performance of these investments, offering the potential for higher returns but also subjecting the policy to investment risks. Policyholders have the flexibility to adjust their premiums and death benefits over time, making it suitable for individuals like Ms. Parker who seek investment growth potential alongside life insurance coverage. In Kansas, variable life insurance policies are regulated by the Kansas Insurance Department to ensure that insurers comply with state laws regarding disclosures, sales practices, and suitability standards to protect consumers' interests. Question 3. Mr. Thompson, a Kansas resident, is interested in a life insurance policy that offers flexibility in premium payments and allows him to adjust the death benefit and coverage period based on his changing needs. Additionally, he wants the potential to earn interest on the cash value of the policy at a competitive rate. Which type of policy should Mr. Thompson consider? A. Term life insurance. B. Whole life insurance. C. Variable life insurance. D. Universal life insurance. The correct answer, D. Universal life insurance. Explanation. Universal life insurance offers flexible premium payments, adjustable death benefits, and the potential to earn interest on the cash value of the policy at a competitive rate. Policyholders can customize their coverage to adapt to changing financial circumstances, such as marriage, the birth of children, or career advancements. The cash value component earns interest based on current market rates or a guaranteed minimum rate set by the insurer. Policyholders can access the cash value through loans or withdrawals, providing liquidity and financial flexibility. In Kansas, universal life insurance policies are regulated to ensure transparency in product features, disclosures, and suitability standards, protecting consumers from unfair practices and ensuring the financial stability of insurers operating in the state. Question 4. Mrs. Hernandez is a Kansas resident and a small business owner. She is interested in purchasing a life insurance policy that offers both protection for her family and potential benefits for her business. Which type of life insurance policy would be most suitable for Mrs. Hernandez's needs? A. Term life insurance. B. Whole life insurance. C. Key person insurance. D. Variable universal life insurance. The correct answer, C. Key person insurance. Explanation. Key person insurance, also known as key man insurance, is designed to protect businesses from financial loss due to the death or disability of a key employee, such as a business owner or a top executive. In Mrs. Hernandez's case, as a small business owner, key person insurance would provide coverage that could be used to offset the financial impact of her unexpected death. It can help cover expenses such as hiring and training a replacement, paying off business debts, or compensating for lost revenue during the transition period. Key person insurance is a valuable tool for businesses in Kansas and is regulated to ensure that policies meet the specific needs of businesses while adhering to state insurance laws and regulations. Question 5. Mr. Smith is a Kansas resident who is concerned about how inflation might affect the purchasing power of his life insurance policy's death benefit over time. He wants a policy that includes a feature to adjust the death benefit to keep pace with inflation. Which type of life insurance policy should Mr. Smith consider? A. Term life insurance with a cost of living rider. B. Whole life insurance with an inflation protection option. C. Universal life insurance with a cost of living adjustment rider. D. Variable universal life insurance with a built-in inflation hedge. The correct answer, A. Term life insurance with a cost of living rider. Explanation. Term life insurance policies typically provide a fixed death benefit for a specific period, but policyholders can add riders to customize their coverage. A cost of living rider, also known as an inflation protection rider, allows the death benefit to increase over time to keep pace with inflation, ensuring that the policy's proceeds maintain their purchasing power. This rider is particularly suitable for individuals like Mr. Smith who want to mitigate the impact of inflation on their beneficiaries' financial security. In Kansas, insurance regulators oversee the use of riders in life insurance policies to ensure transparency, fair pricing, and consumer protection. Question 6. Ms. Taylor, a resident of Kansas, is considering purchasing a life insurance policy to fund her child's education in the event of her premature death. She wants a policy that offers both a death benefit and the opportunity to accumulate cash value over time. Which type of life insurance policy would best meet Ms. Taylor's objectives? A. Term life insurance. B. Whole life insurance. C. Endowment life insurance. D. Variable universal life insurance. The correct answer, C. Endowment life insurance. Explanation. Endowment life insurance provides a death benefit to beneficiaries if the insured dies during the policy term or a lump sum payment to the policyholder if the insured survives the term. The policy accumulates cash value over time, which can be used to fund financial goals such as education expenses. This type of policy offers both protection and savings components, making it suitable for individuals like Ms. Taylor who want to ensure financial security for their loved ones while also building a fund for specific future needs. In Kansas, endowment life insurance policies are regulated to ensure transparency in policy features, disclosures, and suitability standards, protecting consumers' interests and promoting the financial stability of insurers operating in the state. Question 7. Mr. Thompson is a Kansas resident who wants to purchase a life insurance policy that allows him to pay premiums for a specified period while maintaining coverage for his entire life. He also seeks the potential to earn higher returns on the cash value component through investments in separate accounts. Which type of life insurance policy should Mr. Thompson consider? A. Term life insurance with a renewable feature. B. Whole life insurance with a variable interest rate. C. Universal life insurance with a flexible premium option. D. Variable universal life insurance with investment subaccounts. The correct answer, D. Variable universal life insurance with investment subaccounts. Explanation. Variable universal life insurance combines the features of universal life insurance with investment options in separate accounts. Policyholders have the flexibility to adjust premium payments and death benefits while also allocating cash value among various investment subaccounts, such as stocks, bonds, and mutual funds. The cash value and death benefit can fluctuate based on the performance of these investments, offering potential for higher returns but also exposing the policy to investment risks. Variable universal life insurance is suitable for individuals like Mr. Thompson who seek both flexibility and investment opportunities within their life insurance policy. In Kansas, regulations ensure that insurers offering variable universal life insurance comply with state laws governing investments, disclosures, and suitability standards to protect policyholders' interests. Question 8. Mrs. Lee, a resident of Kansas, is interested in a life insurance policy that offers coverage for a specific period to meet her temporary needs, such as paying off a mortgage or covering her children's college expenses. Which type of life insurance policy would be most suitable for Mrs. Lee's situation? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Survivorship life insurance. The correct answer, A. Term life insurance. Explanation. Term life insurance provides coverage for a specific period, typically 10, 20, or 30 years, offering a death benefit to beneficiaries if the insured dies during the term. It is designed to meet temporary needs and is often more affordable than permanent life insurance policies. Term life insurance is suitable for individuals like Mrs. Lee who have short-term financial obligations or specific financial goals, such as paying off debts or providing for dependents' education expenses. In Kansas, term life insurance policies are regulated to ensure transparency in policy terms, pricing, and consumer protections, allowing individuals to make informed decisions based on their financial needs and circumstances. Question 9. Mr. Davis, a Kansas resident, is considering purchasing a life insurance policy to supplement his employer-provided coverage and ensure sufficient protection for his family. He wants a policy that offers guaranteed cash value accumulation and level premiums for the duration of the coverage. Which type of life insurance policy should Mr. Davis consider? A. Term life insurance with a return of premium rider. B. Whole life insurance with a guaranteed cash value. C. Universal life insurance with a flexible premium option. D. Variable universal life insurance with investment subaccounts. The correct answer, B. Whole life insurance with a guaranteed cash value. Explanation. Whole life insurance provides coverage for the insured's entire life with level premiums and a guaranteed death benefit. It also accumulates cash value over time, which grows at a guaranteed rate set by the insurer. The cash value component offers liquidity and can be accessed by the policyholder through loans or withdrawals. Whole life insurance is suitable for individuals like Mr. Davis who seek permanent protection, guaranteed cash value accumulation, and stable premiums. In Kansas, regulations ensure that insurers offering whole life insurance policies comply with state laws regarding policy guarantees, disclosures, and consumer protections, providing peace of mind for policyholders and their beneficiaries. Question 10. Mr. Johnson, a resident of Kansas, wants a life insurance policy that provides coverage for his entire life and allows him to accumulate cash value at a competitive interest rate. He also desires the flexibility to adjust premium payments and death benefits according to his changing financial needs. Which type of life insurance policy should Mr. Johnson consider? A. Term life insurance with a return of premium rider. B. Whole life insurance with a flexible premium option. C. Universal life insurance with a variable interest rate. D. Variable universal life insurance with investment subaccounts. The correct answer, C. Universal life insurance with a variable interest rate. Explanation. Universal life insurance offers flexibility in premium payments and death benefits, along with the opportunity to accumulate cash value at a competitive interest rate. Policyholders can adjust their coverage and premiums to adapt to changing financial circumstances, such as changes in income or expenses. The interest rate credited to the cash value component of universal life insurance policies varies over time based on market conditions, providing the potential for higher returns compared to traditional whole life insurance. Universal life insurance with a variable interest rate is suitable for individuals like Mr. Johnson who seek flexibility and potential growth of their policy's cash value. In Kansas, regulations ensure that insurers offering universal life insurance comply with state laws regarding interest crediting practices, policy disclosures, and consumer protections. Question 11. Mrs. White, a Kansas resident, is interested in a life insurance policy that allows her to purchase additional coverage at specified future dates without providing evidence of insurability. Which type of life insurance policy would offer Mrs. White this flexibility? A. Term life insurance with a renewable feature. B. Whole life insurance with a guaranteed insurability rider. C. Universal life insurance with a flexible premium option. D. Survivorship life insurance with a guaranteed purchase option. The correct answer: D. Survivorship life insurance with a guaranteed purchase option. Explanation. Survivorship life insurance, also known as second-to-die insurance, covers two individuals and pays the death benefit after both insureds have passed away. A guaranteed purchase option rider allows policyholders to purchase additional coverage at specified future dates without undergoing medical underwriting. This feature is valuable for individuals like Mrs. White who anticipate future needs for additional coverage due to life events such as marriage, the birth of children, or business expansions. Survivorship life insurance with a guaranteed purchase option provides flexibility and ensures that Mrs. White can increase her coverage as needed without worrying about her insurability. In Kansas, regulations ensure that insurers offering survivorship life insurance policies with riders comply with state laws regarding policy features, disclosures, and consumer protections. Question 12. Mr. Roberts, a resident of Kansas, is interested in a life insurance policy that provides coverage for a specified period while allowing him to convert to a permanent policy without evidence of insurability. Which type of life insurance policy should Mr. Roberts consider? A. Term life insurance with a convertible option. B. Whole life insurance with a flexible premium option. C. Universal life insurance with a variable interest rate. D. Variable universal life insurance with investment subaccounts. The correct answer: A. Term life insurance with a convertible option. Explanation. Term life insurance policies with a convertible option allow policyholders to convert their term coverage into a permanent policy, such as whole life or universal life insurance, without undergoing medical underwriting. This feature provides flexibility for individuals like Mr. Roberts who may initially opt for term coverage due to its affordability but want the option to convert to permanent coverage in the future as their financial circumstances change. Term life insurance with a convertible option ensures that Mr. Roberts can maintain coverage and access the benefits of permanent life insurance without having to prove insurability at the time of conversion. In Kansas, regulations govern the conversion privileges offered in term life insurance policies to ensure transparency, consumer protections, and compliance with state insurance laws. Question 13. Ms. Garcia is a resident of Kansas who wants to purchase a life insurance policy that provides coverage for her entire life while offering the potential for higher returns through investments in equity securities. However, she also wants the policy to guarantee a minimum death benefit regardless of investment performance. Which type of life insurance policy should Ms. Garcia consider? A. Term life insurance with a return of premium rider. B. Whole life insurance with a variable interest rate. C. Universal life insurance with a guaranteed minimum death benefit. D. Variable universal life insurance with investment subaccounts. The correct answer: D. Variable universal life insurance with investment subaccounts. Explanation. Variable universal life insurance allows policyholders to allocate premiums among different investment subaccounts, including equity securities, while also providing flexibility in premium payments and death benefits. The policy's cash value and death benefit fluctuate based on the performance of these investments, offering the potential for higher returns but also exposing the policy to investment risks. However, to address Ms. Garcia's concern about a minimum death benefit, she can opt for a variable universal life insurance policy with a guaranteed minimum death benefit rider. This rider ensures that her beneficiaries will receive at least a specified amount regardless of the investment performance. Variable universal life insurance with investment subaccounts is suitable for individuals like Ms. Garcia who seek both investment opportunities and permanent life insurance protection. In Kansas, regulations ensure that insurers offering variable universal life insurance policies comply with state laws regarding disclosures, sales practices, and suitability standards to protect consumers' interests. Question 14. Mr. Brown, a Kansas resident, is interested in a life insurance policy that offers flexible premium payments and the potential to accumulate cash value at a competitive interest rate. He also wants the option to adjust his death benefit and coverage period according to his changing needs. Which type of life insurance policy should Mr. Brown consider? A. Term life insurance with a renewable feature. B. Whole life insurance with a guaranteed cash value. C. Universal life insurance with a variable interest rate. D. Variable universal life insurance with investment subaccounts. The correct answer, C. Universal life insurance with a variable interest rate. Explanation. Universal life insurance provides flexibility in premium payments, death benefits, and coverage periods, allowing policyholders to adjust these features to suit their changing financial circumstances. The policy's cash value accumulates at a competitive interest rate, which may vary over time based on market conditions. Universal life insurance with a variable interest rate offers the potential for higher returns compared to traditional whole life insurance policies with guaranteed cash values. This type of policy is suitable for individuals like Mr. Brown who seek flexibility and growth potential within their life insurance coverage. In Kansas, regulations ensure that insurers offering universal life insurance policies comply with state laws regarding interest crediting practices, policy disclosures, and consumer protections. Question 15. Mrs. Clark, a Kansas resident, is interested in purchasing a life insurance policy that provides coverage for her entire life while also accumulating cash value that she can access during her lifetime. However, she wants a policy that guarantees a minimum interest rate on the cash value component. Which type of life insurance policy should Mrs. Clark consider? A. Term life insurance with a return of premium rider. B. Whole life insurance with a guaranteed cash value. C. Universal life insurance with a variable interest rate. D. Variable universal life insurance with investment subaccounts. The correct answer, B. Whole life insurance with a guaranteed cash value. Explanation. Whole life insurance offers coverage for the insured's entire life with level premiums, guaranteed death benefits, and guaranteed cash values. The policy's cash value accumulates at a guaranteed interest rate set by the insurer, providing stability and predictability for the policyholder. Whole life insurance with a guaranteed cash value is suitable for individuals like Mrs. Clark who seek permanent protection, cash value accumulation, and guarantees on the policy's cash value component. In Kansas, regulations ensure that insurers offering whole life insurance policies comply with state laws regarding policy guarantees, disclosures, and consumer protections. Question 16. Mr. Anderson, a resident of Kansas, is considering purchasing a life insurance policy to provide financial protection for his family for a specific period, such as until his children are financially independent. Which type of life insurance policy would best suit Mr. Anderson's needs? A. Whole life insurance. B. Variable life insurance. C. Universal life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance provides coverage for a specific period, such as 10, 20, or 30 years, offering a death benefit to beneficiaries if the insured dies during the term. It is often more affordable than permanent life insurance policies like whole life, variable life, or universal life. Term life insurance is suitable for individuals like Mr. Anderson who have temporary financial obligations or specific financial goals, such as providing for children's education or paying off a mortgage. In Kansas, regulations ensure that insurers offering term life insurance policies comply with state laws regarding policy terms, disclosures, and consumer protections. Question 17. Mrs. Garcia, a Kansas resident, wants a life insurance policy that provides coverage for her mortgage for the next 20 years. She also wants the option to convert the policy to a permanent one in the future without proving insurability. Which type of life insurance policy should Mrs. Garcia consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance is suitable for Mrs. Garcia's needs as it provides coverage for a specific period, such as 20 years, which aligns with the duration of her mortgage. Additionally, term life insurance policies often offer conversion options, allowing policyholders to convert their term coverage to permanent coverage, such as whole life or universal life insurance, without undergoing medical underwriting. This feature ensures that Mrs. Garcia can maintain coverage beyond the initial term if needed, even if her health status changes. In Kansas, regulations ensure that insurers offering term life insurance policies with conversion options comply with state laws regarding policy features, disclosures, and consumer protections. Question 18. Mr. Johnson, a Kansas resident, is comparing different types of life insurance policies to find one that fits his budget and provides coverage for a specific period. He wants to ensure that his family is financially protected if he were to pass away during the policy term. Which type of life insurance policy should Mr. Johnson consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance is suitable for Mr. Johnson's needs as it provides coverage for a specific period at a lower cost compared to permanent life insurance policies like whole life, universal life, or variable life insurance. Term life insurance policies offer a death benefit to beneficiaries if the insured dies during the term, providing financial protection for the insured's family. This makes term life insurance an attractive option for individuals like Mr. Johnson who want affordable coverage for temporary financial needs, such as income replacement or debt repayment. In Kansas, regulations ensure that insurers offering term life insurance policies comply with state laws regarding premium rates, policy terms, and consumer protections. Question 19. Mrs. Rodriguez, a resident of Kansas, is looking for a life insurance policy that provides coverage for her family's financial needs in the event of her untimely death, particularly during the years when her children are young. She wants a policy that offers a fixed premium and death benefit for a specified period. Which type of life insurance policy should Mrs. Rodriguez consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance is suitable for Mrs. Rodriguez's needs as it provides coverage for a specified period, typically 10, 20, or 30 years, at a fixed premium and death benefit. This type of policy offers affordable protection during the years when her family's financial obligations, such as mortgage payments and childcare expenses, are highest. Term life insurance is designed to provide temporary coverage and is often a cost-effective solution for meeting short-term financial needs. In Kansas, regulations ensure that insurers offering term life insurance policies comply with state laws regarding policy terms, premium rates, and consumer protections. Question 20. Mr. Thompson, a Kansas resident, is concerned about the financial impact his premature death could have on his family's ability to pay off their mortgage. He wants a life insurance policy that will cover the outstanding balance of his mortgage for the next 20 years. Which type of life insurance policy should Mr. Thompson consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance is suitable for Mr. Thompson's needs as it provides coverage for a specific period, such as 20 years, which aligns with the duration of his mortgage. Term life insurance policies offer a death benefit to beneficiaries if the insured dies during the term, providing financial protection to cover expenses like mortgage payments. Since term life insurance is temporary coverage, it can be a cost-effective solution for addressing specific financial obligations, such as mortgage debt, during the policy term. In Kansas, regulations ensure that insurers offering term life insurance policies comply with state laws regarding policy features, disclosures, and consumer protections. Question 21. Mrs. Carter, a Kansas resident, wants to purchase a life insurance policy that will provide income replacement for her family in case of her unexpected death during her working years. She anticipates needing coverage for the next 25 years until her youngest child finishes college. Which type of life insurance policy should Mrs. Carter consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance is suitable for Mrs. Carter's needs as it provides coverage for a specified period, such as 25 years, which aligns with the duration of her working years and until her youngest child finishes college. Term life insurance policies offer a death benefit to beneficiaries if the insured dies during the term, providing financial protection to replace lost income and cover expenses like college tuition. Since term life insurance is temporary coverage, it can be a cost-effective solution for addressing specific financial needs during the policy term. In Kansas, regulations ensure that insurers offering term life insurance policies comply with state laws regarding policy terms, premium rates, and consumer protections. Question 22. Mr. Davis, a resident of Kansas, is considering purchasing life insurance to cover his outstanding debts and funeral expenses in case of his untimely death. He wants a policy that offers coverage for a specific period and is budget-friendly. Which type of life insurance policy should Mr. Davis consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance is suitable for Mr. Davis's needs as it provides coverage for a specific period, typically 10, 20, or 30 years, at an affordable premium. It offers a death benefit to beneficiaries if the insured dies during the term, making it ideal for covering short-term financial obligations like debts and funeral expenses. Term life insurance policies are straightforward and do not accumulate cash value, making them a cost-effective solution for individuals like Mr. Davis who seek temporary coverage for specific financial needs. In Kansas, regulations ensure that insurers offering term life insurance policies comply with state laws regarding policy features, disclosures, and consumer protections. Question 23. Mrs. Martinez, a Kansas resident, is interested in purchasing life insurance to provide income replacement for her spouse and children in case of her premature death. She wants a policy that offers coverage until her youngest child graduates from college, which will be in approximately 15 years. Which type of life insurance policy should Mrs. Martinez consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance is suitable for Mrs. Martinez's needs as it provides coverage for a specific period, such as 15 years, which aligns with the duration until her youngest child graduates from college. Term life insurance policies offer a death benefit to beneficiaries if the insured dies during the term, providing financial protection to replace lost income and cover expenses like college tuition. Since term life insurance is temporary coverage, it can be a cost-effective solution for addressing specific financial needs during the policy term. In Kansas, regulations ensure that insurers offering term life insurance policies comply with state laws regarding policy terms, premium rates, and consumer protections. Question 24. Mr. Thompson, a Kansas resident, recently purchased a home and wants to ensure that his mortgage will be paid off if he passes away unexpectedly. He is looking for a life insurance policy that offers coverage for the duration of his mortgage, which is 30 years. Which type of life insurance policy should Mr. Thompson consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. The correct answer, D. Term life insurance. Explanation. Term life insurance is suitable for Mr. Thompson's needs as it provides coverage for a specific period, such as 30 years, which aligns with the duration of his mortgage. Term life insurance policies offer a death benefit to beneficiaries if the insured dies during the term, providing financial protection to cover expenses like mortgage payments. Since term life insurance is temporary coverage, it can be a cost-effective solution for addressing specific financial obligations like mortgage debt during the policy term. In Kansas, regulations ensure that insurers offering term life insurance policies comply with state laws regarding policy terms, premium rates, and consumer protections. Question 25. Mr. Smith, a resident of Kansas, is considering purchasing a life insurance policy specifically designed to cover funeral and burial expenses. Which type of life insurance policy should Mr. Smith consider? A. Whole life insurance. B. Term life insurance. C. Universal life insurance. D. Final expense insurance. The correct answer, D. Final expense insurance. Explanation. Final expense insurance, also known as burial insurance or funeral insurance, is a type of whole life insurance policy designed to cover the costs associated with funeral and burial expenses. It typically offers lower coverage amounts compared to traditional whole life insurance policies, making it more affordable for individuals who only need coverage for final expenses. Final expense insurance policies are often easier to qualify for, with simplified underwriting processes and no medical exams required in some cases. In Kansas, regulations ensure that insurers offering final expense insurance policies comply with state laws regarding policy features, disclosures, and consumer protections. Question 26. Mrs. Johnson, a Kansas resident, is concerned about the financial burden her family may face in covering her funeral expenses when she passes away. She wants a life insurance policy that will provide a lump sum benefit to cover these costs. Which type of life insurance policy should Mrs. Johnson consider? A. Term life insurance. B. Universal life insurance. C. Variable life insurance. D. Final expense insurance. The correct answer, D. Final expense insurance. Explanation. Final expense insurance is suitable for Mrs. Johnson's needs as it provides a lump sum benefit specifically intended to cover funeral and burial expenses. Unlike term life insurance, which provides coverage for a specific period, final expense insurance offers permanent coverage until the insured's death, ensuring that the benefit will be available when needed. In Kansas, regulations ensure that insurers offering final expense insurance policies comply with state laws regarding policy terms, premium rates, and consumer protections. Question 27. Mr. Brown, a Kansas resident, wants to ensure that his family will have the necessary funds to cover his funeral expenses and outstanding debts when he passes away. He is looking for a life insurance policy with a simplified application process and no medical exams required. Which type of life insurance policy should Mr. Brown consider? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Final expense insurance. The correct answer, D. Final expense insurance. Explanation. Final expense insurance is suitable for Mr. Brown's needs as it typically offers a simplified application process with no medical exams required in many cases. This makes it easier for individuals who may have health issues to obtain coverage for funeral and burial expenses without undergoing extensive underwriting. Final expense insurance policies are designed to provide a lump sum benefit to cover final expenses, such as funeral costs, outstanding debts, and other end-of-life expenses. In Kansas, regulations ensure that insurers offering final expense insurance policies comply with state laws regarding policy features, disclosures, and consumer protections. Question 28. Mr. Thompson, a resident of Kansas, wants to ensure that his life insurance policy remains in force even if he becomes disabled and unable to pay the premiums. Which provision should Mr. Thompson look for in his policy to provide this protection? A. Accelerated death benefit provision. B. Waiver of premium provision. C. Guaranteed insurability rider. D. Accidental death benefit provision. The correct answer, B. Waiver of premium provision. Explanation. The waiver of premium provision is designed to waive the payment of premiums if the insured becomes totally disabled and unable to work. This provision ensures that the life insurance policy remains in force during the disability period, providing continued coverage to the insured and their beneficiaries. In Kansas, regulations ensure that insurers offering policies with waiver of premium provisions comply with state laws regarding disability definitions, waiting periods, and other policy provisions to protect consumers' interests. Question 29. Mrs. Garcia, a Kansas resident, is concerned about the financial impact of a terminal illness diagnosis on her family's finances. She wants to access a portion of her life insurance benefit early to cover medical expenses and other costs associated with her illness. Which rider should Mrs. Garcia consider adding to her policy to provide this benefit? A. Accelerated death benefit rider. B. Waiver of premium rider. C. Guaranteed insurability rider. D. Accidental death benefit rider. The correct answer, A. Accelerated death benefit rider. Explanation. The accelerated death benefit rider allows policyholders to receive a portion of their death benefit early if they are diagnosed with a terminal illness or specified medical condition. This benefit provides financial assistance to cover medical expenses and other costs associated with the illness, helping policyholders maintain their quality of life during a challenging time. In Kansas, regulations ensure that insurers offering policies with accelerated death benefit riders comply with state laws regarding rider disclosures, benefit triggers, and consumer protections. Question 30. Mr. Brown, a Kansas resident, wants to ensure that his life insurance coverage keeps pace with his changing financial needs and responsibilities. He is looking for a rider that will allow him to purchase additional coverage at specified future dates without providing evidence of insurability. Which rider should Mr. Brown consider adding to his policy? A. Accelerated death benefit rider. B. Waiver of premium rider. C. Guaranteed insurability rider. D. Accidental death benefit rider. The correct answer, C. Guaranteed insurability rider. Explanation. The guaranteed insurability rider allows policyholders to purchase additional coverage at specified future dates without undergoing medical underwriting. This rider provides flexibility to increase coverage as financial needs change, such as marriage, the birth of children, or business expansions, without having to prove insurability. In Kansas, regulations ensure that insurers offering policies with guaranteed insurability riders comply with state laws regarding rider terms, limitations, and consumer protections. Question 31. Mrs. Martinez, a resident of Kansas, wants to ensure that her life insurance policy provides an additional benefit in case of accidental death. Which rider should Mrs. Martinez consider adding to her policy? A. Accelerated death benefit rider. B. Waiver of premium rider. C. Guaranteed insurability rider. D. Accidental death benefit rider. The correct answer, D. Accidental death benefit rider. Explanation. The accidental death benefit rider provides an additional death benefit if the insured dies as a result of an accident. This rider supplements the base death benefit of the life insurance policy, offering financial protection to the insured's beneficiaries in the event of accidental death. In Kansas, regulations ensure that insurers offering policies with accidental death benefit riders comply with state laws regarding rider disclosures, benefit limitations, and consumer protections. Question 32. Mr. Davis, a Kansas resident, wants to ensure that his life insurance policy provides a benefit that can help cover medical expenses and other costs if he is diagnosed with a critical illness. Which rider should Mr. Davis consider adding to his policy? A. Accelerated death benefit rider. B. Waiver of premium rider. C. Guaranteed insurability rider. D. Critical illness rider. The correct answer, D. Critical illness rider. Explanation. The critical illness rider provides a benefit if the insured is diagnosed with a covered critical illness, such as cancer, heart attack, or stroke. This rider offers a lump sum payment to the insured, allowing them to cover medical expenses, loss of income, or other financial obligations associated with the illness. In Kansas, regulations ensure that insurers offering policies with critical illness riders comply with state laws regarding rider terms, covered conditions, and consumer protections. Question 33. Mrs. Johnson, a Kansas resident, wants to ensure that her life insurance policy provides a benefit that can help cover long-term care expenses if she requires assistance with activities of daily living in the future. Which rider should Mrs. Johnson consider adding to her policy? A. Accelerated death benefit rider. B. Waiver of premium rider. C. Long-term care rider. D. Accidental death benefit rider. The correct answer, C. Long-term care rider. Explanation. The long-term care rider provides benefits to cover long-term care expenses if the insured requires assistance with activities of daily living, such as bathing, dressing, or eating. This rider offers a monthly benefit to help cover the costs of nursing home care, assisted living facilities, or home healthcare services, providing financial protection to the insured and their family. In Kansas, regulations ensure that insurers offering policies with long-term care riders comply with state laws regarding rider terms, benefit triggers, and consumer protections. Question 34. Mrs. Rodriguez, a resident of Kansas, wants to enhance her life insurance policy with coverage for accidental death. Which rider should Mrs. Rodriguez consider adding to her policy for this purpose? A. Accelerated death benefit rider. B. Waiver of premium rider. C. Guaranteed insurability rider. D. Accidental death benefit rider. The correct answer, D. Accidental death benefit rider. Explanation. The accidental death benefit rider provides an additional death benefit if the insured's death results from an accident. This rider supplements the base death benefit of the life insurance policy, offering financial protection to the insured's beneficiaries in case of accidental death. In Kansas, regulations ensure that insurers offering policies with accidental death benefit riders comply with state laws regarding rider disclosures, benefit limitations, and consumer protections. Question 35. Mr. Thompson, a Kansas resident, wants to ensure that his life insurance policy provides additional financial protection in case of accidental death, beyond the base death benefit. Which rider should Mr. Thompson inquire about to achieve this objective? A. Long-term care rider. B. Critical illness rider. C. Accidental death benefit rider. D. Return of premium rider. The correct answer, C. Accidental death benefit rider. Explanation. The accidental death benefit rider provides an additional death benefit if the insured's death is caused by an accident. This rider supplements the base death benefit of the life insurance policy, offering an extra layer of financial protection to the insured's beneficiaries in the event of accidental death. In Kansas, regulations ensure that insurers offering policies with accidental death benefit riders comply with state laws regarding rider terms, disclosures, and consumer protections. Question 36. Mr. Brown, a Kansas resident, is concerned about the financial impact his accidental death could have on his family. He wants to ensure that his life insurance policy provides additional coverage specifically for accidental death scenarios. Which rider should Mr. Brown consider adding to his policy? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accelerated death benefit rider. D. Accidental death benefit rider. The correct answer, D. Accidental death benefit rider. Explanation. The accidental death benefit rider provides an additional death benefit if the insured's death results from an accident. This rider supplements the base death benefit of the life insurance policy, offering extra financial protection to the insured's beneficiaries in case of accidental death. In Kansas, regulations ensure that insurers offering policies with accidental death benefit riders comply with state laws regarding rider terms, disclosures, and consumer protections. Question 37. In Kansas, an insurance agent is creating an advertising campaign to promote a new life insurance product. Which ethical principle should the agent prioritize to ensure compliance with state regulations and consumer protection? A. Truth in advertising. B. Fairness and honesty. C. Professional competence. D. Confidentiality. The correct answer, A. Truth in advertising. Explanation. The correct ethical principle for the insurance agent to prioritize is truth in advertising. In Kansas, insurance marketing and advertising must be accurate, clear, and not misleading. Agents should ensure that all statements made in advertisements are truthful and not deceptive to consumers. Advertisements should not contain false or misleading information about the benefits, terms, or conditions of insurance products. The Kansas Insurance Department regulates insurance marketing practices to protect consumers from deceptive advertising practices and ensure fair treatment in the marketplace. Question 38. Mr. Johnson, an insurance agent in Kansas, is preparing marketing materials to promote a new health insurance plan. Which ethical guideline should Mr. Johnson follow to ensure that his advertising materials are fair and balanced? A. Providing full disclosure. B. Avoiding conflicts of interest. C. Treating customers fairly. D. Maintaining professional integrity. The correct answer, A. Providing full disclosure. Explanation. Mr. Johnson should follow the ethical guideline of providing full disclosure in his advertising materials. This means that he should provide consumers with complete and accurate information about the health insurance plan, including its benefits, limitations, exclusions, and costs. Full disclosure helps consumers make informed decisions about purchasing insurance coverage and reduces the risk of misunderstanding or misrepresentation. In Kansas, insurance agents are required to provide clear and transparent information to consumers in their marketing materials to ensure fairness and protect consumer interests. Question 39. Mrs. Martinez, an insurance agent in Kansas, is designing an advertising campaign for a new life insurance policy. Which ethical consideration should Mrs. Martinez keep in mind to ensure that her advertising complies with state regulations and promotes consumer trust? A. Avoiding deceptive practices. B. Maximizing sales commissions. C. Targeting vulnerable populations. D. Using high-pressure sales tactics. The correct answer, A. Avoiding deceptive practices. Explanation. Mrs. Martinez should prioritize the ethical consideration of avoiding deceptive practices in her advertising campaign. In Kansas, insurance agents are prohibited from engaging in deceptive or unfair practices when marketing insurance products. Deceptive practices include making false or misleading statements, using bait-and-switch tactics, or omitting important information that could influence a consumer's decision. Insurance agents must adhere to ethical standards that promote honesty, transparency, and integrity in advertising to build trust with consumers and maintain the reputation of the insurance industry. Question 40. Ms. Thompson, an insurance agent in Kansas, is preparing an advertisement for a new health insurance policy. Which ethical principle should guide Ms. Thompson to ensure that her advertisement does not exploit consumers' fears or anxieties? A. Confidentiality. B. Professional competence. C. Fairness and honesty. D. Avoiding emotional manipulation. The correct answer, D. Avoiding emotional manipulation. Explanation: Ms. Thompson should adhere to the ethical principle of avoiding emotional manipulation in her advertisement. This means that she should not exploit consumers' fears or anxieties to promote the health insurance policy. Instead, she should focus on providing factual information about the policy's benefits, coverage options, and pricing in a clear and transparent manner. In Kansas, insurance agents are required to conduct marketing and advertising activities with integrity and respect for consumer emotions, ensuring that advertisements do not use fear tactics to influence purchasing decisions. Question 41. Mr. Davis, an insurance agent in Kansas, is drafting a social media post to promote a new life insurance product. Which ethical guideline should Mr. Davis follow to ensure that his social media post respects consumer privacy and confidentiality? A. Providing full disclosure. B. Maintaining professional integrity. C. Avoiding conflicts of interest. D. Safeguarding client information. The correct answer: D. Safeguarding client information. Explanation: Mr. Davis should follow the ethical guideline of safeguarding client information when drafting his social media post. This means that he should not disclose any personal or confidential information about clients without their consent, even in a general marketing context. Insurance agents have a duty to protect the privacy and confidentiality of client information, including information shared on social media platforms. In Kansas, insurance agents must comply with state and federal laws regarding the privacy and security of client information to maintain trust and confidence in the insurance industry. Question 42. Mrs. Brown, an insurance agent in Kansas, is preparing a brochure to promote a new annuity product. Which ethical consideration should Mrs. Brown prioritize to ensure that her brochure provides accurate and balanced information to consumers? A. Maximizing sales commissions. B. Avoiding deceptive practices. C. Targeting vulnerable populations. D. Using high-pressure sales tactics. The correct answer: B. Avoiding deceptive practices. Explanation: Mrs. Brown should prioritize the ethical consideration of avoiding deceptive practices when preparing her brochure. This means that she should provide accurate, truthful, and balanced information about the annuity product, including its features, risks, and potential benefits. Mrs. Brown should avoid making exaggerated claims or using misleading language that could deceive consumers about the nature of the product or its suitability for their needs. In Kansas, insurance agents are required to comply with state regulations prohibiting deceptive advertising practices to protect consumers from harm and promote trust in the insurance marketplace. Question 43. Mr. Martinez, an insurance agent in Kansas, is considering offering incentives to clients who refer their friends and family to purchase insurance policies. Which ethical guideline should Mr. Martinez adhere to when implementing this referral program to ensure fairness and transparency? A. Providing full disclosure. B. Avoiding conflicts of interest. C. Safeguarding client information. D. Maximizing sales commissions. The correct answer: A. Providing full disclosure. Explanation: Mr. Martinez should adhere to the ethical guideline of providing full disclosure when implementing his referral program. This means that he should clearly disclose to clients any incentives or benefits they may receive for referring others to purchase insurance policies. Full disclosure ensures transparency and helps clients make informed decisions about participating in the referral program. In Kansas, insurance agents are required to provide clear and accurate information to clients about any incentives or compensation associated with referral programs to avoid conflicts of interest and maintain trust. Question 44. Ms. Johnson, an insurance agent in Kansas, is preparing an email marketing campaign to promote a new insurance product. Which ethical principle should Ms. Johnson prioritize to ensure that her email communications are respectful and not intrusive to recipients? A. Fairness and honesty. B. Confidentiality. C. Avoiding emotional manipulation. D. Respecting consumer privacy. The correct answer: D. Respecting consumer privacy. Explanation: Ms. Johnson should prioritize the ethical principle of respecting consumer privacy when conducting her email marketing campaign. This means that she should obtain recipients' consent before sending them marketing emails and honor their preferences regarding communication frequency and content. Ms. Johnson should also comply with laws and regulations governing email marketing, such as the CAN-SPAM Act, which requires marketers to provide recipients with a way to opt out of receiving future emails. In Kansas, insurance agents must respect consumer privacy rights and ensure that their marketing practices do not infringe on individuals' privacy or result in unsolicited or intrusive communications. Question 45. Mr. Thompson, an insurance agent in Kansas, is creating a social media advertisement for a new insurance product. Which ethical consideration should Mr. Thompson prioritize to ensure that his advertisement is fair and does not discriminate against any group of consumers? A. Avoiding conflicts of interest. B. Providing full disclosure. C. Treating customers fairly. D. Avoiding deceptive practices. The correct answer: C. Treating customers fairly. Explanation: Mr. Thompson should prioritize the ethical consideration of treating customers fairly when creating his social media advertisement. This means that he should ensure that the advertisement does not discriminate against any group of consumers based on factors such as race, gender, age, or disability. Mr. Thompson should also ensure that the advertisement is inclusive and accessible to all potential customers. In Kansas, insurance agents are required to comply with state and federal laws prohibiting discrimination in insurance marketing and advertising to ensure fair treatment of all consumers in the marketplace. Question 46. Mrs. Garcia, an insurance agent in Kansas, is creating marketing materials for a new health insurance plan. Which ethical guideline should Mrs. Garcia prioritize to ensure that her materials do not exploit vulnerable populations? A. Respecting consumer privacy. B. Avoiding emotional manipulation. C. Providing full disclosure. D. Treating customers fairly. The correct answer: D. Treating customers fairly. Explanation: Mrs. Garcia should prioritize the ethical guideline of treating customers fairly to ensure that her marketing materials do not exploit vulnerable populations. This means that she should design her materials in a way that does not take advantage of consumers' vulnerabilities or coerce them into purchasing insurance products. Mrs. Garcia should provide clear and accurate information about the health insurance plan and avoid using tactics that may prey on the fears or uncertainties of vulnerable populations. In Kansas, insurance agents are required to treat all customers fairly and ensure that their marketing practices do not discriminate or exploit vulnerable individuals. Question 47. Mr. Brown, an insurance agent in Kansas, is considering using testimonials from satisfied clients in his marketing materials. Which ethical consideration should Mr. Brown prioritize when using client testimonials to promote insurance products? A. Respecting consumer privacy. B. Avoiding conflicts of interest. C. Providing full disclosure. D. Ensuring testimonial accuracy. The correct answer: D. Ensuring testimonial accuracy. Explanation: Mr. Brown should prioritize the ethical consideration of ensuring testimonial accuracy when using client testimonials in his marketing materials. This means that he should verify the authenticity of the testimonials and ensure that they accurately represent clients' experiences with the insurance products. Mr. Brown should not misrepresent or exaggerate the benefits of the insurance products based on client testimonials. In Kansas, insurance agents are required to adhere to truth in advertising principles and ensure that their marketing materials, including client testimonials, are accurate and not misleading to consumers. Question 48. Ms. Martinez, an insurance agent in Kansas, is considering offering discounts on insurance premiums as part of a promotional campaign. Which ethical guideline should Ms. Martinez adhere to when offering discounts to ensure fairness and transparency? A. Providing full disclosure. B. Respecting consumer privacy. C. Avoiding conflicts of interest. D. Maximizing sales commissions. The correct answer: A. Providing full disclosure. Explanation: Ms. Martinez should adhere to the ethical guideline of providing full disclosure when offering discounts on insurance premiums. This means that she should clearly disclose the terms and conditions of the discounts, including any eligibility requirements or limitations. Providing full disclosure helps ensure transparency and allows consumers to make informed decisions about purchasing insurance products. In Kansas, insurance agents are required to provide clear and accurate information to consumers about any discounts or promotional offers to prevent misunderstandings and promote trust in the insurance marketplace. Question 49. Mr. Thompson, an insurance agent in Kansas, is reviewing the Professional Code of Conduct for insurance agents and brokers. According to ethical guidelines, what is the primary responsibility of insurance agents and brokers towards their clients? A. Maximizing sales commissions. B. Providing full disclosure. C. Respecting consumer privacy. D. Avoiding conflicts of interest. The correct answer, B. Providing full disclosure. Explanation. Insurance agents and brokers have a primary responsibility to provide full disclosure to their clients. This means that agents must provide clients with all relevant information about insurance policies, including benefits, limitations, costs, and potential risks. Full disclosure ensures that clients can make informed decisions about purchasing insurance coverage. In Kansas, insurance agents are required to adhere to ethical standards that prioritize transparency and honesty in their interactions with clients. Question 50. Mrs. Garcia, an insurance agent in Kansas, is considering recommending an insurance product to a client. According to professional codes of conduct, what should Mrs. Garcia consider to ensure that her recommendation is in the client's best interest? A. Prioritizing company profits. B. Minimizing underwriting risks. C. Disclosing potential conflicts of interest. D. Offering discounts to the client. The correct answer, C. Disclosing potential conflicts of interest. Explanation. Mrs. Garcia should consider disclosing potential conflicts of interest when recommending an insurance product to a client. This means that she should inform the client of any factors that may influence her recommendation, such as financial incentives or affiliations with insurance companies. By disclosing conflicts of interest, Mrs. Garcia can ensure transparency and help the client make an informed decision about purchasing insurance coverage. In Kansas, insurance agents are required to act in the best interests of their clients and disclose any conflicts of interest that may affect their recommendations. Question 51. Mr. Martinez, an insurance broker in Kansas, is advising a client on purchasing a life insurance policy. Which ethical guideline should Mr. Martinez follow to ensure that he provides suitable recommendations tailored to the client's needs and circumstances? A. Providing full disclosure. B. Respecting consumer privacy. C. Offering discounts to the client. D. Conducting a needs analysis. The correct answer, D. Conducting a needs analysis. Explanation. Mr. Martinez should conduct a needs analysis to ensure that he provides suitable recommendations tailored to the client's needs and circumstances. This involves assessing the client's financial situation, goals, and risk tolerance to determine the appropriate type and amount of life insurance coverage. By conducting a needs analysis, Mr. Martinez can recommend insurance products that meet the client's specific needs and provide adequate financial protection. In Kansas, insurance agents and brokers are required to exercise due diligence in assessing clients' needs and recommending suitable insurance solutions. Question 52. Ms. Johnson, an insurance agent in Kansas, is approached by a client who wants to cancel their current life insurance policy and switch to a new one. According to professional codes of conduct, what should Ms. Johnson consider before advising the client on policy changes? A. Explaining the surrender charges. B. Minimizing underwriting risks. C. Maximizing sales commissions. D. Avoiding conflicts of interest. The correct answer, A. Explaining the surrender charges. Explanation. Ms. Johnson should consider explaining the surrender charges to the client before advising on policy changes. Surrender charges are fees imposed by insurance companies for canceling or surrendering a life insurance policy before its maturity date. It's essential for Ms. Johnson to disclose these charges to the client, as they can affect the financial implications of switching policies. By providing full disclosure of surrender charges, Ms. Johnson ensures transparency and helps the client make an informed decision. Question 53. Mr. Brown, an insurance broker in Kansas, is recommending a long-term care insurance policy to a client. Which ethical guideline should Mr. Brown follow to ensure that he acts in the client's best interest? A. Offering discounts to the client. B. Disclosing potential conflicts of interest. C. Prioritizing company profits. D. Avoiding consumer complaints. The correct answer, B. Disclosing potential conflicts of interest. Explanation. Mr. Brown should disclose potential conflicts of interest to ensure that he acts in the client's best interest when recommending a long-term care insurance policy. This involves informing the client of any financial incentives, affiliations, or biases that may influence his recommendation. By disclosing conflicts of interest, Mr. Brown maintains transparency and allows the client to evaluate the recommendation objectively. In Kansas, insurance professionals are obligated to prioritize the client's interests and disclose any conflicts that may impact their advice. Question 54. Mrs. Martinez, an insurance agent in Kansas, is assisting a client with a claim for a health insurance policy. Which ethical principle should Mrs. Martinez prioritize to ensure that the client receives fair and prompt claims settlement? A. Avoiding conflicts of interest. B. Minimizing underwriting risks. C. Respecting consumer privacy. D. Treating customers fairly. The correct answer, D. Treating customers fairly. Explanation. Mrs. Martinez should prioritize the ethical principle of treating customers fairly to ensure that the client receives fair and prompt claims settlement. This involves handling the claim with integrity, empathy, and professionalism, ensuring that the client's needs are met promptly and efficiently. Mrs. Martinez should advocate for the client throughout the claims process, providing support and assistance as needed. In Kansas, insurance agents are required to adhere to ethical standards that prioritize fair treatment of customers and ensure timely and equitable claims settlement. Question 55. Mr. Smith, an insurance agent in Kansas, is considering recommending a variable life insurance policy to a client. Which ethical guideline should Mr. Smith follow to ensure that he provides suitable advice considering the client's risk tolerance? A. Avoiding conflicts of interest. B. Disclosing potential conflicts of interest. C. Conducting a needs analysis. D. Maximizing sales commissions. The correct answer, C. Conducting a needs analysis. Explanation. Mr. Smith should conduct a needs analysis to ensure that he provides suitable advice considering the client's risk tolerance. A needs analysis involves assessing the client's financial goals, risk tolerance, and insurance needs to recommend appropriate insurance products. By conducting a thorough needs analysis, Mr. Smith can tailor his recommendation to match the client's risk tolerance and financial objectives. In Kansas, insurance agents are required to provide suitable advice based on the client's individual circumstances to ensure that their recommendations meet the client's needs. Question 56. Ms. Davis, an insurance broker in Kansas, is approached by a client who wants to purchase a new disability insurance policy. Which ethical principle should Ms. Davis prioritize to ensure that she acts in the client's best interest? A. Avoiding deceptive practices. B. Respecting consumer privacy. C. Maximizing sales commissions. D. Offering discounts to the client. The correct answer, A. Avoiding deceptive practices. Explanation. Ms. Davis should prioritize the ethical principle of avoiding deceptive practices to ensure that she acts in the client's best interest. This involves providing accurate and truthful information about the disability insurance policy, including its coverage, limitations, and costs. Ms. Davis should avoid making false or misleading statements that could deceive the client about the nature of the policy or its benefits. In Kansas, insurance professionals are required to adhere to ethical standards that prohibit deceptive practices and ensure that their recommendations are based on honest and transparent communication with clients. Question 57. Mr. Thompson, an insurance agent in Kansas, is considering recommending a whole life insurance policy to a client. Which ethical consideration should Mr. Thompson prioritize to ensure that his recommendation aligns with the client's long-term financial goals? A. Providing full disclosure. B. Minimizing underwriting risks. C. Avoiding conflicts of interest. D. Maximizing sales commissions. The correct answer, A. Providing full disclosure. Explanation. Mr. Thompson should prioritize providing full disclosure to ensure that his recommendation aligns with the client's long-term financial goals. This involves explaining the features, benefits, and limitations of the whole life insurance policy, as well as any associated costs and risks. By providing full disclosure, Mr. Thompson enables the client to make an informed decision based on their individual financial situation and objectives. In Kansas, insurance agents are required to provide transparent and honest information to clients to help them make sound financial decisions. Question 58. Mr. Johnson, a resident of Kansas, is considering purchasing a life insurance policy with a critical illness rider. What is the primary purpose of a critical illness rider in a life insurance policy? A. To provide coverage for routine medical expenses. B. To provide a lump sum benefit upon diagnosis of a specified illness. C. To offer investment opportunities. D. To cover funeral expenses. The correct answer, B. To provide a lump sum benefit upon diagnosis of a specified illness. Explanation. The primary purpose of a critical illness rider in a life insurance policy is to provide a lump sum benefit to the policyholder upon the diagnosis of a specified illness covered by the rider. This benefit can help policyholders cover medical expenses, mortgage payments, or other financial obligations during a critical illness, providing financial support during a challenging time. In Kansas, critical illness riders are designed to supplement traditional health insurance coverage and provide additional financial protection in the event of a serious illness diagnosis. Question 59. Ms. Martinez, a policyholder in Kansas, has been diagnosed with a covered critical illness and is eligible to receive benefits under her life insurance policy's critical illness rider. How are the benefits typically paid out under a critical illness rider? A. In monthly installments. B. As a lump sum. C. Through investment returns. D. In the form of premium refunds. The correct answer, B. As a lump sum. Explanation. Benefits under a critical illness rider are typically paid out as a lump sum upon the diagnosis of a covered illness. This lump sum payment provides policyholders with immediate access to funds to cover medical expenses, replace lost income, or meet other financial needs resulting from the critical illness. In Kansas, insurance companies offer critical illness riders with varying benefit amounts and coverage options, allowing policyholders to customize their coverage to meet their specific needs. Question 60. Mrs. Brown, a policyholder in Kansas, is considering adding a critical illness rider to her existing life insurance policy. What is a key advantage of having a critical illness rider? A. It provides coverage for routine medical expenses. B. It offers investment opportunities. C. It provides financial protection in the event of a serious illness diagnosis. D. It covers funeral expenses. The correct answer, C. It provides financial protection in the event of a serious illness diagnosis. Explanation. A key advantage of having a critical illness rider is that it provides financial protection in the event of a serious illness diagnosis. The lump sum benefit provided by the rider can help policyholders cover medical expenses, replace lost income, or maintain their standard of living during a critical illness without depleting their savings or retirement funds. In Kansas, critical illness riders offer policyholders peace of mind knowing that they have additional financial support in the event of a covered illness diagnosis. Question 61. Mrs. Garcia is comparing different critical illness riders offered by insurance companies in Kansas. What factors should she consider when evaluating the coverage provided by these riders? A. The premium cost of the rider. B. The investment returns associated with the rider. C. The coverage exclusions and limitations. D. The availability of routine medical checkups. The correct answer, C. The coverage exclusions and limitations. Explanation. When evaluating critical illness riders, Mrs. Garcia should consider the coverage exclusions and limitations. These details specify the illnesses covered by the rider and any conditions or restrictions associated with the benefit payout. Understanding the coverage exclusions and limitations is crucial for policyholders to ensure they have adequate protection for potential critical illnesses. In Kansas, insurance companies must provide clear information about the coverage details of critical illness riders to help consumers make informed decisions. Question 62. Mr. Thompson is considering purchasing a life insurance policy with a critical illness rider. How does the presence of a critical illness rider affect the premium cost of the life insurance policy? A. It increases the premium cost of the policy. B. It decreases the premium cost of the policy. C. It has no impact on the premium cost of the policy. D. It increases the death benefit of the policy. The correct answer, A. It increases the premium cost of the policy. Explanation. The presence of a critical illness rider typically increases the premium cost of the life insurance policy. This is because the critical illness rider provides additional coverage, resulting in higher premiums to account for the increased risk of a benefit payout due to a covered critical illness. Policyholders should consider their budget and coverage needs when deciding whether to add a critical illness rider to their life insurance policy. In Kansas, insurance companies must disclose the premium cost associated with critical illness riders to ensure transparency in pricing. Question 63. Ms. Davis, a policyholder in Kansas, has been diagnosed with a covered critical illness and is eligible to receive benefits under her life insurance policy's critical illness rider. What is the typical waiting period before the benefits become payable under the rider? A. 30 days. B. 90 days. C. 180 days. D. 365 days. The correct answer, B. 90 days. Explanation. The typical waiting period before benefits become payable under a critical illness rider is 90 days after the diagnosis of a covered critical illness. This waiting period, also known as the elimination period, is designed to ensure that the diagnosis is genuine and to prevent fraudulent claims. Policyholders should be aware of the waiting period associated with their critical illness rider to understand when they are eligible to receive benefits. In Kansas, insurance companies must clearly disclose the waiting period and other policy terms related to critical illness riders to policyholders. Question 64. Mr. Rodriguez is considering adding a critical illness rider to his life insurance policy in Kansas. What is the typical age range at which individuals can purchase a critical illness rider? A. 18 to 30 years. B. 30 to 50 years. C. 50 to 70 years. D. 70 to 90 years. The correct answer, B. 30 to 50 years. Explanation. The typical age range at which individuals can purchase a critical illness rider is usually between 30 and 50 years. Insurance companies may impose age restrictions on the purchase of critical illness riders to manage risk and ensure affordability. Younger individuals may find it more cost-effective to purchase a critical illness rider when they are healthier and less likely to develop serious illnesses. In Kansas, individuals should consider their age and health status when deciding whether to add a critical illness rider to their life insurance policy. Question 65. Ms. Lee, a policyholder in Kansas, wants to know if her critical illness rider covers cancer. What should Ms. Lee review to determine if cancer is covered under her critical illness rider? A. The policy's death benefit. B. The policy's premium cost. C. The policy's coverage exclusions and limitations. D. The policy's investment returns. The correct answer, C. The policy's coverage exclusions and limitations. Explanation. To determine if cancer is covered under her critical illness rider, Ms. Lee should review the policy's coverage exclusions and limitations. These details specify the illnesses covered by the rider, including whether cancer is included in the list of covered conditions. Understanding the coverage details is essential for policyholders to ensure they have adequate protection for potential critical illnesses such as cancer. In Kansas, insurance companies must provide clear information about the coverage provided by critical illness riders to policyholders. Question 66. Mr. Patel is reviewing his life insurance policy with a critical illness rider in Kansas. What should Mr. Patel consider regarding the benefit payout under the critical illness rider? A. The benefit payout is tax deductible. B. The benefit payout is subject to income tax. C. The benefit payout is only available to policy beneficiaries. D. The benefit payout is not affected by the policy's death benefit. The correct answer, B. The benefit payout is subject to income tax. Explanation. Mr. Patel should consider that the benefit payout under the critical illness rider is generally subject to income tax. While the premium payments for the rider are typically made with after-tax dollars, the benefit payout may be considered taxable income when received by the policyholder. Policyholders should consult with a tax advisor to understand the tax implications of receiving benefits under a critical illness rider. In Kansas, insurance companies must provide clear information about the tax treatment of benefits under critical illness riders to policyholders. Question 67. Mrs. Nguyen is considering purchasing a life insurance policy with a critical illness rider. What is a common requirement for policyholders to qualify for benefits under the critical illness rider? A. Being diagnosed with a covered illness. B. Maintaining a healthy lifestyle. C. Paying higher premiums. D. Holding the policy for a specific duration. The correct answer, A. Being diagnosed with a covered illness. Explanation. A common requirement for policyholders to qualify for benefits under the critical illness rider is being diagnosed with a covered illness as specified in the policy. Policyholders must meet the criteria outlined in the policy to trigger the benefit payout, which typically includes receiving a diagnosis of a covered critical illness. In Kansas, insurance companies must clearly define the conditions under which policyholders are eligible to receive benefits under the critical illness rider. Question 68. Mr. Thompson is reviewing his life insurance policy with a critical illness rider in Kansas. What should Mr. Thompson consider regarding the duration of coverage provided by the critical illness rider? A. The coverage lasts for the policyholder's lifetime. B. The coverage lasts for a fixed term. C. The coverage ends when the policyholder reaches a certain age. D. The coverage is renewable annually. The correct answer, B. The coverage lasts for a fixed term. Explanation. Mr. Thompson should consider that the coverage provided by the critical illness rider typically lasts for a fixed term, as specified in the policy. The duration of coverage may vary depending on the terms and conditions of the rider and the insurance company. Policyholders should review their policy documents carefully to understand the duration of coverage provided by the critical illness rider. In Kansas, insurance companies must provide clear information about the duration of coverage and any renewal options available under critical illness riders. Question 69. Ms. Garcia, a policyholder in Kansas, wants to add a critical illness rider to her existing life insurance policy. What should Ms. Garcia consider regarding the waiting period before the benefits become payable under the rider? A. The waiting period is typically shorter for younger policyholders. B. The waiting period varies depending on the insurance company. C. The waiting period is waived for certain illnesses. D. The waiting period is longer for pre-existing conditions. The correct answer, B. The waiting period varies depending on the insurance company. Explanation. Ms. Garcia should consider that the waiting period before the benefits become payable under the critical illness rider varies depending on the insurance company and the terms of the rider. Some insurance companies may offer shorter waiting periods or waive the waiting period for certain illnesses, while others may impose longer waiting periods. Policyholders should review their policy documents to understand the waiting period and any conditions associated with benefit eligibility under the critical illness rider. In Kansas, insurance companies must disclose the waiting period and other policy terms related to critical illness riders to policyholders. Question 70. What is a primary consideration during the underwriting process for health insurance policies in Kansas? A. Evaluating the insured property's location. B. Assessing the policyholder's driving record. C. Reviewing the applicant's medical history and health condition. D. Analyzing the liability risks associated with the insured individual. The correct answer: C. Reviewing the applicant's medical history and health condition. Explanation: during the underwriting process for health insurance policies in Kansas, a primary consideration is reviewing the applicant's medical history and health condition. Insurers assess the risk associated with insuring an individual based on factors such as pre-existing medical conditions, lifestyle habits, and family medical history. This evaluation helps determine the premium rates and coverage options offered to the applicant. Question 71. In the underwriting process for property insurance policies in Kansas, what factor is typically assessed to determine the premium rates? A. The insured individual's medical history. B. The condition and age of the insured property. C. The driving record of the insured individual. D. The liability risks associated with the insured individual. The correct answer: B. The condition and age of the insured property. Explanation: in the underwriting process for property insurance policies in Kansas, insurers typically assess the condition and age of the insured property to determine premium rates. Factors such as the property's construction materials, location, and susceptibility to risks such as natural disasters are considered. Insurers may also evaluate the property's security features and maintenance history when calculating premiums. Question 72. Mr. Smith is applying for liability insurance coverage in Kansas for his business. What aspect of the underwriting process is particularly important for liability insurance? A. Evaluating the condition of the insured property. B. Reviewing the applicant's medical history. C. Assessing the applicant's risk exposure and business operations. D. Analyzing the driving record of the insured individual. The correct answer: C. Assessing the applicant's risk exposure and business operations. Explanation: in the underwriting process for liability insurance in Kansas, assessing the applicant's risk exposure and business operations is particularly important. Insurers analyze factors such as the nature of the business, the extent of potential liabilities, and risk management practices to determine the appropriate coverage and premium rates. This evaluation helps insurers understand the level of risk associated with insuring the business and ensures that the policy provides adequate protection against potential liabilities. Question 73. When underwriting a liability insurance policy in Kansas, what is the primary purpose of assessing the applicant's risk exposure? A. To determine the condition of the insured property. B. To evaluate the applicant's driving record. C. To assess the likelihood of potential claims against the insured individual or business. D. To analyze the applicant's medical history. The correct answer: C. To assess the likelihood of potential claims against the insured individual or business. Explanation: in the underwriting process for liability insurance policies in Kansas, assessing the applicant's risk exposure aims to evaluate the likelihood of potential claims against the insured individual or business. Insurers analyze various factors such as the nature of the activities conducted, previous claims history, and the extent of potential liabilities to determine the level of risk associated with providing coverage. This assessment helps insurers set appropriate premium rates and coverage limits. Question 74. What role does the underwriting process play in determining premium rates for different types of insurance policies in Kansas? A. It sets fixed premium rates for all applicants. B. It evaluates the applicant's financial assets. C. It assesses the risk associated with insuring the applicant. D. It determines the coverage limits for the insured property. The correct answer, C. It assesses the risk associated with insuring the applicant. Explanation. The underwriting process plays a crucial role in determining premium rates for different types of insurance policies in Kansas by assessing the risk associated with insuring the applicant. Insurers evaluate various factors such as the applicant's age, health condition, lifestyle habits, claims history, and the characteristics of the insured property or business operations. Based on this assessment, insurers calculate premium rates that reflect the level of risk and ensure sufficient funds to cover potential claims. Question 75. How does the underwriting process for health insurance differ from that of property insurance in Kansas? A. Health insurance underwriting focuses primarily on assessing the condition of the insured property. B. Property insurance underwriting involves evaluating the applicant's medical history and health condition. C. Health insurance underwriting considers the applicant's medical history and health condition. D. Property insurance underwriting primarily assesses the applicant's risk exposure and business operations. The correct answer, C. Health insurance underwriting considers the applicant's medical history and health condition. Explanation. In Kansas, the underwriting process for health insurance differs from that of property insurance by focusing on assessing the applicant's medical history and health condition. Health insurers evaluate factors such as pre-existing medical conditions, lifestyle habits, and family medical history to determine the applicant's risk profile and set appropriate premium rates. In contrast, property insurance underwriting primarily assesses factors related to the condition and risk exposure of the insured property. Question 76. In the underwriting process for property insurance in Kansas, what role does the inspection of the insured property play? A. It determines the insured individual's driving record. B. It assesses the applicant's risk exposure and business operations. C. It helps evaluate the condition and risk associated with the insured property. D. It analyzes the applicant's medical history and health condition. The correct answer, C. It helps evaluate the condition and risk associated with the insured property. Explanation. During the underwriting process for property insurance in Kansas, the inspection of the insured property plays a crucial role in evaluating the condition and risk associated with the property. Insurers may conduct physical inspections or utilize external reports to assess factors such as the property's construction, maintenance, security features, and susceptibility to risks such as natural disasters. This information helps insurers determine the appropriate coverage and premium rates for the property. Question 77. What is the significance of the underwriting process in determining the coverage limits for insurance policies in Kansas? A. It sets fixed coverage limits for all applicants. B. It assesses the applicant's financial assets. C. It evaluates the risk associated with insuring the applicant. D. It determines the condition of the insured property. The correct answer, C. It evaluates the risk associated with insuring the applicant. Explanation. The underwriting process plays a significant role in determining the coverage limits for insurance policies in Kansas by evaluating the risk associated with insuring the applicant. Insurers assess various factors such as the applicant's risk profile, claims history, and the characteristics of the insured property or business operations to determine the appropriate coverage limits. Higher-risk applicants may receive lower coverage limits or face coverage exclusions, while lower-risk applicants may qualify for higher coverage limits. Question 78. How does the underwriting process for liability insurance differ from that of health insurance in Kansas? A. Liability insurance underwriting focuses primarily on assessing the applicant's medical history and health condition. B. Health insurance underwriting involves evaluating the applicant's risk exposure and business operations. C. Liability insurance underwriting primarily assesses the applicant's risk exposure and business operations. D. Health insurance underwriting primarily determines the condition of the insured property. The correct answer, C. Liability insurance underwriting primarily assesses the applicant's risk exposure and business operations. Explanation. In Kansas, the underwriting process for liability insurance differs from that of health insurance by primarily focusing on assessing the applicant's risk exposure and business operations. Liability insurers evaluate factors such as the nature of the applicant's business, previous claims history, and risk management practices to determine the level of risk associated with providing coverage. Health insurance underwriting, on the other hand, primarily focuses on assessing the applicant's medical history and health condition to evaluate the risk of potential healthcare expenses. Question 79. During the underwriting process for health insurance in Kansas, what factors might insurers consider when evaluating an applicant's risk profile? A. The condition of the insured property. B. The applicant's driving record. C. The applicant's medical history and health condition. D. The liability risks associated with the insured individual. The correct answer, C. The applicant's medical history and health condition. Explanation. In the underwriting process for health insurance in Kansas, insurers typically consider the applicant's medical history and health condition to assess their risk profile. This evaluation helps insurers determine the likelihood of the applicant requiring medical services and the associated costs. Factors such as pre-existing conditions, family medical history, and lifestyle habits may influence the underwriting decision and premium rates. Question 80. How does the underwriting process for liability insurance differ from property insurance in Kansas? A. Liability insurance underwriting primarily focuses on assessing the condition of the insured property. B. Property insurance underwriting involves evaluating the applicant's risk exposure and business operations. C. Liability insurance underwriting primarily assesses the applicant's risk exposure and business operations. D. Property insurance underwriting primarily determines the applicant's medical history. The correct answer, C. Liability insurance underwriting primarily assesses the applicant's risk exposure and business operations. Explanation. The underwriting process for liability insurance differs from property insurance in Kansas by primarily focusing on assessing the applicant's risk exposure and business operations. Liability insurers evaluate factors such as the nature of the applicant's business activities, previous claims history, and risk management practices to determine the level of risk associated with providing coverage. Property insurance underwriting, on the other hand, primarily assesses the condition and risk of the insured property. Question 81. In the underwriting process for health insurance policies in Kansas, how might an applicant's age impact their premium rates? A. Younger applicants typically pay higher premiums due to their higher risk profile. B. Older applicants typically pay lower premiums due to their lower risk profile. C. Premium rates remain unaffected by the applicant's age. D. Premium rates vary based on the applicant's age, with older individuals generally paying higher premiums. The correct answer, D. Premium rates vary based on the applicant's age, with older individuals generally paying higher premiums. Explanation. In Kansas, premium rates for health insurance policies often vary based on the applicant's age. Older individuals may face higher premiums due to factors such as increased healthcare utilization and the higher likelihood of developing health conditions. Insurers adjust premium rates to reflect the age-related risk factors associated with providing coverage. Younger applicants may benefit from lower premium rates, reflecting their generally lower risk profile and lower likelihood of requiring medical services. Question 82. In the underwriting process for life insurance in Kansas, which of the following tools is commonly used to assess an applicant's risk of mortality? A. Credit score analysis. B. Medical exams and health questionnaires. C. Property valuation reports. D. Driving history check. The correct answer, B. Medical exams and health questionnaires. Explanation. Life insurance underwriters in Kansas commonly use medical exams and health questionnaires to assess an applicant's risk of mortality. These tools provide crucial information about the applicant's current health status, medical history, and lifestyle habits, allowing underwriters to evaluate the likelihood of premature death and set appropriate premium rates. Credit score analysis, property valuation reports, and driving history checks are more commonly associated with other types of insurance underwriting, such as property and casualty insurance. Question 83. When assessing an applicant's risk profile for health insurance in Kansas, which of the following factors is typically considered by underwriters? A. Property ownership. B. Occupation and income level. C. Vehicle usage. D. Investment portfolio. The correct answer, B. Occupation and income level. Explanation. In Kansas, health insurance underwriters typically consider factors such as the applicant's occupation and income level when assessing their risk profile. Occupation may influence exposure to health risks and potential injuries, while income level can impact access to healthcare and the likelihood of maintaining coverage. Property ownership, vehicle usage, and investment portfolio are more relevant to other types of insurance underwriting, such as property and casualty or life insurance. Question 84. Which risk assessment methodology is commonly used by underwriters to evaluate the potential likelihood and severity of future insurance claims in Kansas? A. Actuarial analysis. B. Market research. C. Customer surveys. D. Legal assessments. The correct answer, A. Actuarial analysis. Explanation. In Kansas, underwriters often rely on actuarial analysis to assess the potential likelihood and severity of future insurance claims. Actuaries use mathematical models and statistical techniques to analyze historical data, mortality rates, healthcare trends, and other relevant factors to estimate risk and set appropriate premium rates. Market research, customer surveys, and legal assessments may provide valuable insights but are not primary methodologies used for risk assessment in underwriting. Question 85. In Kansas, what role do underwriters play in utilizing predictive modeling techniques during the underwriting process for life insurance? A. Identifying potential legal risks. B. Assessing the applicant's driving history. C. Predicting future mortality and morbidity risks. D. Analyzing property valuation reports. The correct answer, C. Predicting future mortality and morbidity risks. Explanation. Underwriters in Kansas utilize predictive modeling techniques primarily to predict future mortality and morbidity risks associated with applicants for life insurance. These techniques involve analyzing various factors such as age, gender, medical history, lifestyle habits, and family health history to estimate the likelihood of death or illness during the policy term. Predictive modeling helps insurers assess risk more accurately and set appropriate premium rates. Question 86. What is the significance of underwriters assessing an applicant's occupation and income level during the underwriting process for disability insurance in Kansas? A. It helps determine the condition of the insured property. B. It assesses the applicant's risk of premature death. C. It evaluates the likelihood of the applicant becoming disabled and unable to work. D. It analyzes the applicant's medical history. The correct answer, C. It evaluates the likelihood of the applicant becoming disabled and unable to work. Explanation. In Kansas, assessing an applicant's occupation and income level during the underwriting process for disability insurance is significant because it helps evaluate the likelihood of the applicant becoming disabled and unable to work. Certain occupations may carry higher risks of disability due to workplace hazards or physical demands, while income level can indicate the financial impact of disability on the applicant's lifestyle. This information assists underwriters in determining coverage eligibility and setting appropriate premium rates. Question 87. Which of the following tools is commonly used by underwriters to assess an applicant's risk of morbidity in health insurance underwriting in Kansas? A. Driving history check. B. Medical exams and health questionnaires. C. Property valuation reports. D. Credit score analysis. The correct answer, B. Medical exams and health questionnaires. Explanation. Underwriters in Kansas commonly use medical exams and health questionnaires to assess an applicant's risk of morbidity in health insurance underwriting. These tools provide detailed information about the applicant's current health status, medical conditions, and lifestyle factors that may affect their risk of illness or injury. Driving history checks, property valuation reports, and credit score analysis are more relevant to other types of insurance underwriting, such as auto insurance and property insurance. Question 88. When evaluating an applicant's risk profile for life insurance in Kansas, which of the following factors is typically considered in assessing the likelihood of premature death? A. Occupation and income level. B. Vehicle usage and driving history. C. Property ownership and valuation. D. Investment portfolio and credit score. The correct answer, A. Occupation and income level. Explanation. In Kansas, underwriters assessing risk for life insurance often consider the applicant's occupation and income level, as these factors can influence the likelihood of premature death. Certain occupations may involve higher risks of accidents or exposure to hazardous conditions, while income level may correlate with access to healthcare and lifestyle choices. Vehicle usage, property ownership, investment portfolio, and credit score are more relevant to other types of insurance underwriting. Question 89. During the underwriting process for health insurance in Kansas, why do underwriters often review an applicant's medical history and health condition? A. To determine the condition of the insured property. B. To assess the applicant's risk of premature death. C. To evaluate the likelihood of the applicant requiring medical services. D. To analyze the applicant's driving history. The correct answer, C. To evaluate the likelihood of the applicant requiring medical services. Explanation. Underwriters in Kansas review an applicant's medical history and health condition during the underwriting process for health insurance to evaluate the likelihood of the applicant requiring medical services. This information helps insurers assess the potential frequency and cost of healthcare services, which influences premium rates and coverage decisions. The applicant's medical history provides insights into pre-existing conditions, ongoing treatments, and overall health status. Question 90. Which of the following risk assessment methodologies is commonly used by underwriters to determine premium rates for life insurance policies in Kansas? A. Actuarial analysis. B. Market research. C. Customer surveys. D. Legal assessments. The correct answer, A. Actuarial analysis. Explanation. Underwriters in Kansas commonly use actuarial analysis to determine premium rates for life insurance policies. Actuarial analysis involves using statistical models and mathematical techniques to assess risk, estimate future claims, and set appropriate premium rates based on factors such as mortality rates, life expectancy, and policyholder demographics. Market research, customer surveys, and legal assessments are not primary methodologies used for determining premium rates in life insurance underwriting. Question 91. In Kansas, underwriters utilize a variety of sources to assess an applicant's risk profile for insurance. Which of the following sources is commonly used to gather information about an applicant's financial stability and payment history? A. Medical records. B. Credit reports. C. Driving records. D. Property appraisal reports. The correct answer, B. Credit reports. Explanation. In Kansas, underwriters often refer to credit reports to assess an applicant's financial stability and payment history. Credit reports provide information about an individual's credit score, debt obligations, and payment history, which can indicate their likelihood of fulfilling insurance premium payments. While medical records, driving records, and property appraisal reports may provide valuable information, credit reports are specifically used to evaluate an applicant's financial reliability. Question 92. During the underwriting process for disability insurance in Kansas, what role does an applicant's occupation play in assessing their risk profile? A. It determines the condition of the insured property. B. It evaluates the likelihood of the applicant's vehicle usage. C. It assesses the probability of the applicant becoming disabled and unable to work. D. It analyzes the applicant's investment portfolio. The correct answer, C. It assesses the probability of the applicant becoming disabled and unable to work. Explanation. In Kansas, an applicant's occupation is crucial in assessing their risk profile for disability insurance. Certain occupations may involve higher risks of disability due to workplace hazards or physical demands, which can impact the likelihood of the applicant becoming disabled and unable to work. Therefore, underwriters consider the nature of the applicant's occupation to determine their eligibility for coverage and to set appropriate premium rates. Question 93. Which of the following risk assessment tools is commonly used by underwriters to evaluate an applicant's risk of mortality in life insurance underwriting in Kansas? A. Driving history check. B. Medical exams and health questionnaires. C. Property valuation reports. D. Customer surveys. The correct answer, B. Medical exams and health questionnaires. Explanation. In Kansas, underwriters commonly utilize medical exams and health questionnaires to evaluate an applicant's risk of mortality in life insurance underwriting. These tools provide comprehensive information about the applicant's current health status, medical conditions, and lifestyle habits, which are essential factors in assessing their risk of premature death. Driving history checks, property valuation reports, and customer surveys are not directly related to assessing mortality risk in life insurance underwriting. Question 94. In Kansas, how do life insurance underwriters utilize actuarial tables during the underwriting process? A. To determine the insured's creditworthiness. B. To assess the likelihood of a claim being filed. C. To estimate the probability of the insured's death. D. To evaluate the market value of the insured's assets. The correct answer, C. To estimate the probability of the insured's death. Explanation. Life insurance underwriters in Kansas use actuarial tables to estimate the probability of the insured's death within a given time frame. These tables are based on statistical data and mortality rates, allowing underwriters to assess risk and determine appropriate premium rates for life insurance policies. Question 95. Which of the following statements accurately describes the role of mortality tables in life insurance underwriting in Kansas? A. Mortality tables help underwriters assess the insured's investment portfolio. B. Mortality tables assist underwriters in estimating the insured's risk of disability. C. Mortality tables provide data on life expectancy and death probabilities. D. Mortality tables determine the insured's eligibility for health insurance coverage. The correct answer, C. Mortality tables provide data on life expectancy and death probabilities. Explanation. Mortality tables, also known as life tables, provide statistical data on life expectancy and death probabilities at various ages. In Kansas, life insurance underwriters use mortality tables to assess the risk of death for policyholders, helping them make informed decisions regarding coverage and premium rates. Question 96. How do underwriters in Kansas utilize mortality tables when determining premium rates for life insurance policies? A. By calculating the insured's potential returns on investment. B. By estimating the insured's risk of property damage or loss. C. By assessing the probability of the insured's death and the associated claims. D. By evaluating the insured's credit score and financial stability. The correct answer, C. By assessing the probability of the insured's death and the associated claims. Explanation. In Kansas, underwriters use mortality tables to assess the probability of the insured's death and the associated claims that may arise from the policy. By analyzing mortality data, underwriters can determine appropriate premium rates that account for the risk of potential payouts due to the insured's death. This helps ensure that premiums are set at levels sufficient to cover potential claims while maintaining profitability for the insurer. Question 97. In Kansas, How do life insurance underwriters utilize actuarial tables when assessing risk for policyholders? A. To estimate the likelihood of the insured experiencing a disability. B. To determine the insured's eligibility for health insurance coverage. C. To evaluate the probability of the insured's death within a specific time frame. D. To assess the value of the insured's property and assets. The correct answer, C. To evaluate the probability of the insured's death within a specific time frame. Explanation. Life insurance underwriters in Kansas use actuarial tables to evaluate the probability of the insured's death within a specific time frame. These tables provide statistical data and mortality rates, allowing underwriters to assess the risk associated with insuring the individual and to set appropriate premium rates. Question 98. Which of the following best describes the purpose of mortality tables in life insurance underwriting in Kansas? A. Mortality tables help underwriters estimate the insured's investment returns. B. Mortality tables provide data on the insured's credit history and financial stability. C. Mortality tables assist underwriters in determining the probability of the insured's death. D. Mortality tables evaluate the insured's risk of property damage or loss. The correct answer, C. Mortality tables assist underwriters in determining the probability of the insured's death. Explanation. Mortality tables are used by life insurance underwriters in Kansas to determine the probability of the insured's death at various ages. These tables provide valuable statistical data on life expectancy and death probabilities, allowing underwriters to assess risk and make informed decisions regarding coverage and premium rates. Question 99. How do underwriters in Kansas utilize actuarial tables when calculating premium rates for life insurance policies? A. By estimating the insured's likelihood of filing a claim. B. By assessing the insured's risk of disability and inability to work. C. By evaluating the probability of the insured's death and associated claims. D. By determining the insured's eligibility for property insurance coverage. The correct answer, C. By evaluating the probability of the insured's death and associated claims. Explanation. Underwriters in Kansas use actuarial tables to evaluate the probability of the insured's death and associated claims when calculating premium rates for life insurance policies. These tables provide valuable data on mortality rates, allowing underwriters to set appropriate premium levels that account for the risk of potential payouts due to the insured's death. Question 100. In Kansas, how do underwriters utilize mortality tables when assessing risk for life insurance policies? A. To determine the insured's eligibility for disability benefits. B. To estimate the probability of the insured outliving the policy term. C. To evaluate the insured's likelihood of experiencing property damage. D. To assess the insured's investment portfolio performance. The correct answer, B. To estimate the probability of the insured outliving the policy term. Explanation. Underwriters in Kansas use mortality tables to estimate the probability of the insured outliving the policy term. These tables provide data on life expectancy and death probabilities, allowing underwriters to assess the risk of the insured living beyond the policy's duration and adjust premium rates accordingly. Question 101. How do actuarial tables assist underwriters in Kansas when determining premium rates for life insurance policies? A. By evaluating the insured's driving history and risk of accidents. B. By estimating the insured's likelihood of filing a health insurance claim. C. By assessing the probability of the insured's death and associated claims. D. By determining the insured's eligibility for property insurance coverage. The correct answer, C. By assessing the probability of the insured's death and associated claims. Explanation. Actuarial tables help underwriters in Kansas assess the probability of the insured's death and associated claims when determining premium rates for life insurance policies. These tables provide statistical data on mortality rates, allowing underwriters to set appropriate premium levels that reflect the risk of potential payouts due to the insured's death. Question 102. Which of the following statements accurately describes how underwriters use mortality tables in Kansas during the underwriting process? A. Mortality tables help underwriters estimate the insured's risk of property damage. B. Mortality tables assist underwriters in assessing the insured's creditworthiness. C. Mortality tables provide data on life expectancy and death probabilities. D. Mortality tables determine the insured's eligibility for disability benefits. The correct answer: C. Mortality tables provide data on life expectancy and death probabilities. Explanation: in Kansas, underwriters use mortality tables to access data on life expectancy and death probabilities. These tables are essential in assessing the risk associated with insuring an individual's life and help underwriters make informed decisions about coverage and premium rates. Question 103. In Kansas, what is the primary purpose of the premium paid by the policy owner for a life insurance policy? A. To cover administrative expenses incurred by the insurance company. B. To provide investment returns to the policy owner. C. To fund the death benefit payable upon the insured's death. D. To compensate the insurance agent for selling the policy. The correct answer: C. To fund the death benefit payable upon the insured's death. Explanation: in Kansas, the premium paid by the policy owner primarily serves to fund the death benefit payable upon the insured's death. This benefit provides financial protection to the policy owner's beneficiaries in the event of the insured's death during the policy term. The premium amount is determined based on factors such as the insured's age, health, and coverage amount, and it ensures that the death benefit is available when needed. Question 104. What rights does a policy owner in Kansas typically have regarding their life insurance policy? A. The right to cancel the policy at any time without penalty. B. The right to change the beneficiary designation without the insurer's consent. C. The right to determine the premium amount payable for the policy. D. The right to receive dividends from the insurance company's profits. The correct answer: A. The right to cancel the policy at any time without penalty. Explanation: in Kansas, a policy owner typically has the right to cancel the life insurance policy at any time without penalty. This right ensures that policy owners have control over their insurance coverage and can make changes as their circumstances change. However, it's important to note that canceling a policy may result in the forfeiture of any accumulated cash value or benefits associated with the policy. Question 105. Which of the following best describes the relationship between premiums and benefits in a life insurance policy in Kansas? A. Premiums are paid by the insurance company to the policy owner as benefits. B. Premiums represent the cost of coverage, while benefits are the payments made to beneficiaries. C. Premiums and benefits are interchangeable terms for the same aspect of the policy. D. Premiums are calculated based on the benefits received by the insured. The correct answer: B. Premiums represent the cost of coverage, while benefits are the payments made to beneficiaries. Explanation: in Kansas, premiums represent the cost of coverage for a life insurance policy, while benefits are the payments made to beneficiaries upon the insured's death. The premium amount is determined based on factors such as the insured's age, health, and coverage amount, while the benefits provide financial protection to the insured's beneficiaries. It's essential for policy owners to understand this relationship to make informed decisions about their life insurance coverage. Question 106. In Kansas, what is typically the consequence of a policy owner failing to pay the premium for their life insurance policy on time? A. The insurance company must waive the premium payment. B. The policy automatically converts to a paid-up policy with reduced benefits. C. The policy lapses, resulting in a loss of coverage. D. The policy owner can defer payment without any penalties. The correct answer: C. The policy lapses, resulting in a loss of coverage. Explanation: in Kansas, if a policy owner fails to pay the premium for their life insurance policy on time, the policy typically lapses, resulting in a loss of coverage. This means that the insurance company will terminate the policy, and the policy owner and beneficiaries will no longer have access to the benefits provided by the policy. It's crucial for policy owners to stay current on premium payments to maintain coverage. Question 107. What role do dividends play in a participating life insurance policy in Kansas? A. Dividends are paid to the insurance company by the policy owner. B. Dividends represent the return of unused premiums to the policy owner. C. Dividends are distributed to policy owners from the insurance company's profits. D. Dividends are added to the policy's death benefit automatically. The correct answer: C. Dividends are distributed to policy owners from the insurance company's profits. Explanation: in Kansas, dividends in a participating life insurance policy are distributed to policy owners from the insurance company's profits. Policy owners may choose to receive dividends in cash, use them to reduce premiums, accumulate them with interest, or purchase additional insurance coverage. These dividends are considered a form of policy owners' return of surplus and can enhance the policy's overall value. Question 108. Which statement accurately describes the concept of cash value in a permanent life insurance policy in Kansas? A. Cash value represents the death benefit payable upon the insured's death. B. Cash value is the total amount of premiums paid by the policy owner. C. Cash value is a savings component that accumulates over time within the policy. D. Cash value is the portion of the premium used to cover administrative expenses. The correct answer: C. Cash value is a savings component that accumulates over time within the policy. Explanation: in Kansas, cash value in a permanent life insurance policy is a savings component that accumulates over time within the policy. It represents the portion of premiums not used for the cost of insurance and expenses. Policy owners can access the cash value through policy loans or withdrawals, providing them with a source of funds for various financial needs. Question 109. In Kansas, what happens to the death benefit of a life insurance policy if the policy owner does not designate a beneficiary? A. The death benefit is paid to the insured's estate. B. The death benefit is forfeited to the insurance company. C. The death benefit is distributed among the insured's heirs according to state law. D. The death benefit is paid to the insurance agent who sold the policy. The correct answer: A. The death benefit is paid to the insured's estate. Explanation: in Kansas, if a policy owner does not designate a beneficiary for their life insurance policy, the death benefit is typically paid to the insured's estate. The estate then distributes the proceeds according to the insured's will or state intestacy laws if no will exists. It's essential for policy owners to update their beneficiary designations regularly to ensure that the death benefit is distributed according to their wishes. Question 110. Which statement accurately describes the non-forfeiture options available to a policy owner in Kansas? A. Non-forfeiture options allow the policy owner to forfeit the policy in exchange for a cash refund. B. Non-forfeiture options provide the policy owner with the right to convert the policy to a term insurance policy. C. Non-forfeiture options allow the policy owner to maintain the policy's cash value even if premiums are not paid. D. Non-forfeiture options enable the policy owner to receive a reduced paid-up policy or extended term insurance. The correct answer: D. Non-forfeiture options enable the policy owner to receive a reduced paid-up policy or extended term insurance. Explanation: in Kansas, non-forfeiture options allow the policy owner to receive a reduced paid-up policy or extended term insurance if the policy lapses due to non-payment of premiums. With a reduced paid-up policy, the death benefit is reduced, but no further premiums are required. With extended term insurance, the full death benefit continues for a specified period without additional premiums. These options provide policy owners with alternatives to maintain some form of coverage even if they are unable to continue paying premiums. Question 111. How does the policy loan provision benefit a policy owner in Kansas? A. It allows the policy owner to borrow against the cash value of the policy. B. It provides the policy owner with a waiver of premium payment in case of disability. C. It enables the policy owner to transfer ownership of the policy to another individual. D. It grants the policy owner the right to surrender the policy for its cash surrender value. The correct answer, A. It allows the policy owner to borrow against the cash value of the policy. Explanation. In Kansas, the policy loan provision allows the policy owner to borrow against the cash value of the policy. Policy owners can use the cash value as collateral to obtain a loan from the insurance company. These loans typically accrue interest, and any unpaid loan balance reduces the death benefit payable to beneficiaries. Policy owners can use policy loans for various purposes, such as paying premiums, covering unexpected expenses, or supplementing retirement income. Question 112. What happens to the cash value in a permanent life insurance policy if the policy owner surrenders the policy? A. The cash value is forfeited to the insurance company. B. The cash value is paid out to the policy owner. C. The cash value is used to pay off any outstanding policy loans. D. The cash value is distributed among the beneficiaries. The correct answer, C. The cash value is used to pay off any outstanding policy loans. Explanation. In Kansas, if a policy owner surrenders a permanent life insurance policy, any outstanding policy loans are deducted from the cash value before the remaining amount is paid out to the policy owner. Surrendering a policy terminates coverage and may result in taxation on any gains in the cash value. Question 113. How does the cash value in a permanent life insurance policy grow over time? A. Through premium payments made by the policy owner. B. Through investment returns earned by the insurance company. C. Through dividends paid by the insurance company. D. Through a combination of premium payments and interest credited by the insurance company. The correct answer, D. Through a combination of premium payments and interest credited by the insurance company. Explanation. In Kansas, the cash value in a permanent life insurance policy grows over time through a combination of premium payments made by the policy owner and interest credited by the insurance company. The insurance company invests the premiums and guarantees a minimum interest rate on the cash value, allowing it to accumulate over the life of the policy. Question 114. Which factor typically affects the rate of cash value accumulation in a permanent life insurance policy? A. The age and health of the insured. B. The term length of the policy. C. The amount of the death benefit. D. The frequency of premium payments. The correct answer, A. The age and health of the insured. Explanation. In Kansas, the rate of cash value accumulation in a permanent life insurance policy is often influenced by the age and health of the insured. Younger and healthier individuals tend to have lower mortality costs, allowing more of the premium to be allocated towards cash value accumulation. Additionally, policies with longer durations may also see higher cash value accumulation due to the longer investment horizon. Question 115. What happens to the cash value in a permanent life insurance policy if the policy owner decides to take a policy loan? A. The cash value remains untouched. B. The cash value decreases by the amount of the loan plus interest. C. The cash value increases due to the loan. D. The cash value is transferred to a separate account. The correct answer, B. The cash value decreases by the amount of the loan plus interest. Explanation. In Kansas, when a policy owner takes a loan against the cash value of a permanent life insurance policy, the cash value serves as collateral for the loan. The cash value decreases by the amount of the loan plus any accrued interest. If the loan is not repaid, it may reduce the death benefit payable to beneficiaries. Question 116. Which type of permanent life insurance policy typically offers a cash value component that is invested in separate accounts, similar to mutual funds? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Indexed universal life insurance. The correct answer, C. Variable life insurance. Explanation. In Kansas, variable life insurance policies offer a cash value component that can be invested in separate accounts, similar to mutual funds. The cash value fluctuates based on the performance of the underlying investments chosen by the policy owner. This type of policy provides the potential for higher returns but also carries investment risks. Question 117. How does the cash value in a permanent life insurance policy affect the policy owner's financial planning options? A. It provides a guaranteed income stream in retirement. B. It can be used as collateral for loans or withdrawals. C. It reduces the need for additional savings and investments. D. It has no impact on the policy owner's financial planning. The correct answer, B. It can be used as collateral for loans or withdrawals. Explanation. In Kansas, the cash value in a permanent life insurance policy can be accessed by the policy owner through policy loans or withdrawals. This provides liquidity and flexibility in financial planning, allowing the policy owner to use the cash value for various purposes such as supplementing retirement income, funding education expenses, or covering emergencies. However, policy loans and withdrawals may impact the death benefit and cash value growth if not repaid or managed properly. Question 118. When an annuity holder makes a withdrawal from their annuity, how are the earnings taxed? A. Earnings are always tax-free. B. Earnings are taxed as ordinary income. C. Earnings are taxed at a lower capital gains rate. D. Earnings are taxed at a higher rate than ordinary income. The correct answer, B. Earnings are taxed as ordinary income. Explanation. In Kansas, when an annuity holder makes a withdrawal from their annuity, the earnings portion of the withdrawal is taxed as ordinary income. This means that the earnings are subject to federal and state income taxes at the annuitant's applicable tax rate. The portion of the withdrawal that represents a return of the annuitant's original investment basis is not subject to income tax. Question 119. What is the tax treatment of annuity distributions taken before the age of 59.5? A. Distributions are always tax-free. B. Distributions are subject to a 10% penalty in addition to ordinary income tax. C. Distributions are taxed at a reduced rate. D. Distributions are not allowed before age 59.5. The correct answer, B. Distributions are subject to a 10% penalty in addition to ordinary income tax. Explanation. In Kansas, if an annuity holder takes a distribution before reaching the age of 59.5, the distribution may be subject to a 10% early withdrawal penalty imposed by the IRS, in addition to being taxed as ordinary income. Certain exceptions may apply to avoid the penalty, such as for disability, death, or certain qualified expenses. Question 120. Which of the following annuity distribution options allows the annuitant to spread out the tax liability over time? A. Lump sum distribution. B. Systematic withdrawal plan. C. Annuitization. D. Partial withdrawal. The correct answer, C. Annuitization. Explanation. In Kansas, when an annuity holder chooses annuitization, they convert their annuity contract into a series of periodic payments, which may include both a return of principal and interest. With annuitization, the tax liability is spread out over the duration of the annuity payments, as only a portion of each payment represents taxable earnings, while the remainder represents a return of the annuitant's original investment. This can help minimize the immediate tax impact compared to taking a lump sum distribution or other withdrawal options.